they get margin calls and forced sales of their bond portfolio, which causes margin calls and forced sales of other weak banks' bond portfolios, and the whole thing comes crashing down. Hey guys, Raf here from the End Game Investor, and today we're going to talk about why we're not going to have persistently high consumer price inflation. We're going to have a crack up boom. I'm going to show you why this is the case with the current money supply, which is now deflating at an all-time record pace. I keep saying that, but it keeps being true. And when I say deflating, I mean that the amount of money in the US banking system is falling at the fastest pace on record. And we have records going back to 1982, weekly statistics from the Federal Reserve. Second, when we talk about the financial pyramid, the pyramid of credit derivatives, the institutions that hold this pyramid up are the generally systemically important banks, or the G-SIBs. If one of them falls, all of them fall unless they are bailed out by a central bank. And there will be another bailout by a central bank to keep the pyramid stable, at least in nominal terms, which does not mean stable for your wallet. It means stable for the banking cartel. And right now, it looks like one of those load-bearing candy canes of the financial pyramid that has been constructed since 1933 is about to collapse. And that pillar is Credit Suisse.
Oh, that's a load-bearing candy cane, you clumsy oaf!
This video is brought to you by
Lightspeed Briefs. Style and comfort for the discriminating crotch.
No, actually, it's brought to you by Uranium Royalty Corp, symbol UROY. Unlike the green energy movement, which is based on taking away your rights and liberties and making us all slaves in some kind of new feudalism project, uranium actually is a clean energy alternative to fossil fuels. There are no greenhouse gases associated with nuclear energy. So this is just a little bit about the uranium situation. And uranium, as you may know, is named after Uranus, which is, I think, a Roman god of something in that planet that spins the wrong way.
Astronomers renamed Uranus to end that stupid joke once and for all. Oh, what's it called now? Eurectum.
Then I guess they would have to rename it Euractium, but that's not happening. So anyway, uranium production in the U.S. Uranium production in the U.S., you see, since about 2014, it's been falling to about zero. So given that about 20% of all electric power, 20% of all homes in the United States is powered by uranium, the U.S. pretty much imports all of its uranium now, and they're gonna have to pick up production pretty soon, like now, if they want to secure their nuclear energy supplies. As uranium production has fallen off a cliff to zero practically, uranium consumption by year in thousands of metric tons has stayed pretty stable since production has curled off to nothing. We're still at about 18.3 thousand metric tons of uranium consumption per year. And so where is the balance of US uranium coming from? 35% Kazakhstan.
Kazakhstan is the greatest country in the world.
And 14% from Russia. Well, there's going to be a problem there. 5%, only 5% of the actual stuff comes from the US itself. Now, in terms of uranium royalty, it roughly correlates with gold stocks, which makes sense. Resource stocks move together. So you can see uranium royalty, UROY, in the candles on this chart, and it more or less moves in correlation with gold stocks. So if you're invested in gold stocks and this is the kind of movement you can tolerate, then uranium royalty might fit your portfolio. And it is a speculative stock. So uranium royalty both holds physical uranium, so it functions sort of like a uranium ETF, not exactly, because its main business is royalty streamers. It buys interest in uranium projects, fronts the money, and gets a percentage of the profits. We see here that uranium prices are about $50.35 a pound. And as price inflation increases, you can bet that uranium prices are going to increase as well. We saw what happened in the spike in 2006, 2007. That could very well happen again as the currency breaks down. And as the currency breaks down, as the dollar breaks down, there are going to be problems with energy supplies, and uranium is going to be a big part of that. And who are the main backers of Uranium Royalty Corp? It is Extract Capital, Altius Resources under Rick Rule, Mega Uranium Limited under Sprott Global, you know Sprott, Marin Katusa, Commodity Capital, and KCR Fund. Basically, the company does have significant backing, and I've put the corporate presentation in the link in the description below for those who are interested in possibly investing in this company. And I do personally own the stock as one of my speculative positions. Now, I wanted to address something that Lynn Alden tweeted out a few days ago. I am a fan of Lynn Alden. I just want to put my perspective out there, which is a little bit different from hers. Here's the tweet. She says, November 17th, good graphic for how broad prices tend to be after a wave of inflation cools down. Quoting Lobo Tigre, another good friend of mine. Here's the link. My cartoon remains relevant. And here he shows the line on inflation, price inflation going up and up and up, then leveling off and going a little bit higher, 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 higher. I don't think that's what's going to happen this time. She says price inflation that is only from supply chain bottlenecks would go back to pre-bottleneck levels after the issue is resolved. Price inflation that is in significant part from monetary expansion stays at a new higher level indefinitely. This all sounds reasonable on the surface, that you can divide consumer price gains between supply chain problems and monetary inflation and actually divide it in percentages like that. But that's really trying to become a little bit too econometric and break things down in ways that human action doesn't really allow. What I think is going to happen, broadly speaking, from here on out is that we're going to see a massive crash in asset prices very soon. And from there, the Fed is going to have to make its final pivot, at which point consumer prices are going to start going vertical, and we're going to see the hyperinflationary death of the reserve currency of the world and a move to gold and silver physically in the initial stages. How long this is going to take, I'm not sure, but once it starts, the process of dissolution of the financial pyramid is going to take weeks to months, not longer than that. Why do I think that this is the path and not just persistently higher consumer prices for months or years on end? Because of this. This is the weekly money supply chart going back to 1980. This is how many dollars exists in the US banking system. And now we've never seen anything like this. This was the great money pump of 2020. Yes, we all know about that. It continued until about April 2022 or thereabouts. And from then, we've been in a severe deflationary environment at the tail end of this chart. We'll zoom in right here. Here's the 5-year look. This is the money supply shrinking in absolute terms since April 2022, April 18, 2022. Now, if we zoom in further, here is the 1-year chart. This is money supply not coming back up after the giant fall. We're down from 22 trillion to now 21.35 trillion, which is a fall of about $650 billion since April. The reasons for this are the hikes in interest rates, which causes a slowdown in monetary transactions, which causes a slowdown in the growth of the credit supply. It's all connected. And once the credit supply stops growing, then asset prices are what fall first. And when asset prices fall fast, chiefly bonds, then you have the entire financial pyramid starting to implode. And when that happens, the central bank has to start bailing things out again. Now, if you look at this money supply chart that I jiggered going back to 2006, this is the quarterly average, and I showed this before, the quarterly average money supply. So here we see that we are down below the zero mark at this line here, going back all the way to 2006. Only one time did we cross that line, and that was in 2008. This 2009 was deflation after the already asset price crash of 2008. So we're cutting that one out, but we haven't seen an asset price crash yet. We've seen a little bit of a deflation, but not a serious crash yet. That is still ahead of us. You cannot have these numbers when you have a shrinking money supply in absolute terms on a quarterly basis and not have an equities crash. The question is when? Well, why haven't we seen it already? My thinking is that this huge money pump of 2020, which was totally unprecedented, there's still some hangover, some leftover money supply from that huge pump back in 2020 that still has to be sucked into the sidelines. I don't know how much longer it's going to take before everything falls, but when it does, we're going to see that final pivot. It's not going to take years like Lynn Alden suggested. She didn't specifically say years, but it's not going to be persistently higher price inflation. There's going to be a crack up boom of insanity. So here you have the final numbers. For the week of October 31st, we're at negative 3.24% in monetary shrinkage rate. That rate has never been hit before in the history of these numbers ever. And what are we going to see prior to a major crash or concurrent with a major crash in asset prices, including stocks and bonds and all other stuff? Well, we could see a major G-SIB bank like Credit Suisse blow up. Here is a list of all the systemically important banks, the generally systemically important banks in the world. And we have in tier 1, or is that tier bucket? Bucket, not tier, bucket.
The game's Mr. Bucket. The first to get their balls into Mr. Bucket wins, but look out, because the balls will pop out of his mouth. Mr. Bucket.
Bucket 1, we have Credit Suisse over here, sandwiched between China Construction Bank and Group BPCE. The biggest systemically important bank in the world is JP Morgan Chase, and then followed by Bank of America, Citigroup, and HSBC. Bank of China, Barclays, BNP Paribas, Deutsche Bank, Goldman Sachs, Industrial and Commercial Bank of China, Mitsubishi, UFJFG. There's a handful of banks here, and Credit Suisse is one of them. But what has been happening to Credit Suisse lately? Credit Suisse hits new low as investors weigh outflow damage. Credit Suisse AG fell to a fresh record low as investors weighed the impact of the massive outflows the bank reported this week, and news that rivals in the key growth market of Asia are benefiting from the Swiss firm's troubles. Shares of the lender declined as much as 5% in Zurich on Friday after Vontobel cut its price target and said the firm urgently needs to halt outflows in its core wealth management business. Credit Suisse announced on Wednesday that clients had pulled about 84 billion francs, or $89 billion, in the first 6 weeks of the fourth quarter, with no reversal in sight. This is a classic bank run, and the stock is doing extremely poorly at a record low. But the scary part is this. Let's go to its annual report, and you'll see here the pyramid is shaky. Now, forget about the stock price of Credit Suisse for a second. Just think about what's under the hood of this gigantic bank, which is dying. You have here a paragraph on page 174 of its annual report, Development of Selected European Credit Risk Exposures. On a gross basis, before taking into account risk mitigation, our risk-based sovereign credit risk exposure to Cyprus, Greece, Ireland, Italy, Malta, Portugal, and Spain, the pigs of Europe, which are incredibly indebted and whose bonds are worthless, increased 292% to 8.8 billion euros as of December 31st, 2021, compared to 2.2 billion euros as of December 31st, 2020. Our net exposure to these sovereigns was 8.8 billion, 352% higher compared to euro 943 million as of December 31st, 2020. And so their investment in these pigs' sovereign credit bubbles is higher than their own market cap, which is about $9.4 billion. You can see from here, market cap $9.394 billion. And that's what makes this bank systemically important, because it holds an enormous portfolio of bonds, which are going to have to be liquidated if it goes bankrupt. But that won't happen because they're going to have to be bailed out. And they will be, because if they are not, then there are cross defaults. They get margin calls and forced sales of their bond portfolio, which causes margin calls and forced sales of other weak banks' bond portfolios, and the whole thing comes crashing down. To stop this, the Fed is going to print one last time. And at that point, consumers are going to understand that there is no end to this inflationary cycle. And not caring about what the CPI is going to be in a month from now, they're just going to dump the money for anything they can to survive, which means they're going to stand in line at supermarkets. They're going to stand in line at Costco's. They're going to get rid of their dollars as fast as they can. This is way before any central bank digital currency is going to appear, and the dollar will be dead before that horror baby is ever born. This is the Misesian crack-up boom. You cannot sustain high inflation, high price inflation in a reserve currency for very long before the public wakes up and dumps it. Thanks for watching me this week. Check out the sponsor in the link in the description below. Consider a 2-week free trial of the Endgame Investor before the Endgame hits. And you can become a patron on Patreon and get an additional video on biblical commentary on monetary and economic policy topics. This week, we're going to go into why creating wealth is not a zero-sum game, according to Genesis, and why, of course, the commies were wrong. And we see the first instance of that in ancient Canaan.